about that. I mean, not only now, normally arbitrage it ends quickly because all the money flows to where the arbitrage is.
Totally.
Well, they're not letting it end. They're keeping the premium there to entice this continual sucking of metal out of the West. That if you listen closely, you hear that sucking sound. Not only are they going to pay that premium, but they're paying a premium and the VAT tax ultimately. So it goes to show what they really think about the price of gold and silver, that
Exactly.
its value is far more than the paper currency that is being used to buy it. And that's exactly what you're seeing in that. So
If you want to know what the smartest, most heavily capitalized institutions think about the future of the US dollar, stop listening to what they tell the media and start watching what they're doing with physical assets. In this clip with Jared from the Stacking Surfer, precious metals expert Andy Schectman explains a massive wealth transfer happening in real time, and it breaks the traditional rules of finance. In a normal market, if gold is cheaper in London and more expensive in Shanghai, traders step in immediately. They buy low, sell high, and close the gap. That's arbitrage. And those price differences usually disappear within hours or days. But that isn't happening right now. Eastern exchanges, especially the Shanghai Gold Exchange, are maintaining a strong, persistent premium over Western paper markets. They're paying more per ounce and even absorbing a 13% value-added tax, all to take physical delivery and move metal out of New York and London vaults. As Schectman puts it, there's a continual sucking of metal out of the West. The East is willing to overpay in fiat because they've done the math. Owning finite, tangible assets today makes more sense than holding Western paper promises tomorrow. They're trading printable currency for hard assets. And when sovereign buyers are ready to accept a 13% tax just to secure physical metal, that's not random trading. That's a systemic shift, a sign that the foundation of the global financial system may be changing.
look, this is a situation where, the dollar system is based on confidence, Jared, and the confidence is gone in many ways. And so on one hand, you look at what China is doing. They just told their large banks to stop loading up on U.S. Treasuries, in fact, to trim exposure on them. They are starting to treat U.S. government debt or our bonds like it's a concentration risk, not the ultimate safe haven that we've always been told. And they're speeding up their exit from the dollar and de-risking the dollar system. I think that's something from a primary standpoint that people need to understand.
This is the macroeconomic earthquake that the mainstream financial media is either entirely missing or deliberately ignoring. For the last 50 years, the entire global financial system has operated on one unquestionable assumption. United States Treasury debt is the ultimate, pristine, risk-free asset. When a foreign nation exported goods to the United States, they took the billions of dollars they earned and dutifully parked them right back into U.S. Treasury bonds. It was a perfect, closed-loop system of complete global confidence. It kept interest rates low and allowed the West to borrow endlessly. But right now, that confidence is breaking in real time. We are watching superpower nations openly categorize U.S. debt not as a safe haven, but as a severe concentration risk. When you hold trillions of dollars of debt from a country that is currently running massive, multi-trillion-dollar annual deficits, struggling with sticky inflation, and openly weaponizing its currency network through global sanctions, that debt is no longer a safe store of value. It has become a massive systemic liability. So, what do foreign central banks and massive institutional players do when they realize the math no longer works? They de-risk. They quietly stop buying new U.S. Treasuries at auction. They let their existing bonds mature and roll off their balance sheets. And most importantly, they take that capital and buy the only asset on Earth that carries absolutely zero counterparty risk: physical gold and physical silver. This is the exact structural reason why we are seeing that massive physical drain from the West to the East. The global pricing center of gravity is slowly but violently shifting from paper derivatives traded by algorithms in New York to physical deliverable metal settled in Asia. But the Western exchanges are not going down without a fight. They are trying desperately to manage this stress and keep the paper illusion going, And the cracks are starting to show in the very mechanics of how the market actually functions.
The interesting thing about this is that the registered silver, the metal that is actually available to deliver, is around 90 million ounces. So do the math. Demand for delivery spikes. COMEX has two options: either drain the registered inventory fast or force incentives like higher premiums or roll pressure, meaning we want you to cash settle or roll it into the next month, and we'll give you a premium, a carrot, let's call it, to do so. We'll pay you extra money to settle in cash or to roll it forward. And this is how stress shows up, not in the price, it's in the delivery mechanics. And that is what we're seeing. And the market stays calm until it doesn't.
To understand how disconnected this system has become, you need to see the difference between paper claims and physical reality. On the COMEX, traders buy and sell futures contracts all day. For decades, it's mostly been a financial game. Hedge funds and bullion banks trade contracts representing hundreds of millions of ounces of silver, but very few ever ask for the actual metal. Most just settle in cash. Now look at the math. There are hundreds of millions of ounces tied to open paper contracts, yet the registered category, the silver actually sitting in vaults, ready for delivery, is around 90 million ounces. Think of it like an airline that sold 400 tickets for a plane with only 90 seats. As long as most passengers accept a voucher and don't board, everything looks fine. But what happens if everyone shows up and demands their seat? That's the situation with physical silver. Far more claims exist than metal available. When sovereign buyers and big money see this imbalance, they stop playing the paper game. They demand delivery. And when that pressure rises, the exchange can't print silver the way the Federal Reserve prints dollars. So instead, they apply roll pressure, offering cash incentives to convince contract holders to settle in dollars rather than take the metal. This is what stress looks like before a structural break. It doesn't show up immediately in the daily price ticker. It shows up behind the scenes, in delivery strain, shrinking inventories, and aggressive efforts to keep the paper system intact. And when that paper system finally hits a wall, the biggest players will protect themselves first, not the retail investor.
The big money is using this cover of drive-by shooting, of raising of margins, of price that is very volatile and frightening, to run cover for standing for delivery for massive amounts. And they are more than happy to knock it down and take delivery at subsidized prices. At the same time, knock out all the levered longs who are on margin, who aren't able to continue to post margin in this environment. This is classic shake the hell out of the bushes, and it can't go on forever because the stockpiles of availability are at record lows or fast approaching it.
This final clip exposes how retail investors get wiped out while big banks quietly build generational wealth. When physical vault levels drop too low, exchanges suddenly raise margin requirements. That means smaller traders using leverage must deposit large amounts of extra cash overnight just to keep their positions open. Most can't, so they're force liquidated. The exchange sells their positions, triggering a sharp drop in the paper price. It looks like a natural crash. The media panics, stop losses get hit, and retail investors rush out of the market. Meanwhile, behind the scenes, deep-pocketed institutions and sovereign buyers step in to buy physical metal at discounted prices. Weak hands are forced out. Strong hands accumulate. This pattern has shown up on exchanges like the COMEX again and again. The system favors those who control the rules. Margin requirements change when it protects large players. Currency can be expanded by central banks like the Federal Reserve, slowly eroding purchasing power. But physical assets can't be printed. You can't win a game where the house sets the rules and prints the chips. The only real edge is stepping outside that system, not just rotating between paper assets, but building something independent and resilient. I hope you found that helpful. And if you live in the US and you want to buy some solid physical gold or silver for your retirement account, check out the free guide in the description below. See you in the next video.